You've joined the presentation listening using your computer speaker system by default. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We'll collect these and address them during the Q&A session at the end of today's presentation. Today's webinar is being recorded. You'll receive a follow-up email within 24 to 48 hours with a link to view the recording. With that, I would now like to introduce Demica's Chief Commercial Officer, Maurice Benisti, to begin the webinar.
We've got Chris Edson, who's joining us from Apollo. Chris will introduce himself in a moment. And the theme that we're going to go into today, apart from the usual kind of run through of what we're seeing on the platform and what we're seeing in the market, is how did the change in economic conditions, which need no further explanation, kind of feed into the way the private equity is looking at investment, and that's investment in a broader sense, not just direct private equity investment, but investment across a range of asset classes, including trade, and then for us to kind of go a bit deeper into what's happening in the trade finance market. What are we seeing? Again, what's Apollo seeing? So it's going to be a great session. We've got a great audience attendance registered and joining. And so without further ado, Chris, why don't you tell us a little bit more about Apollo, if it needs any introduction, and perhaps some of the things you've done and are doing.
Yeah, sure. Thanks for having me today. So I've been at Apollo for going on 15 years now, and the firm has changed a lot over that time period. The firm really started as a private equity focused business. It expanded into other forms of opportunistic investing. And 15 years ago, this firm had 30 or 40 billion of assets under management, and 80 or 90% of it was focused on equity, private equity, and opportunistic investing. Today, it's almost the exact opposite. We still have a very large opportunistic business. We have a very large private equity fund, but all of that only adds up to about 20% of what Apollo is today. The other 80% of Apollo is that we've really become a very large insurance company. We own a business called Athene, which we started about 12 or 13 years ago. That business has grown to almost 300 billion of assets. We have another company called Athora, another insurance company called Athora that's in Europe that has about 80 billion of assets. And then we have some other sister companies that end up adding up to close to 400 billion of total insurance capital. So 80% of our money is insurance or insurance-like money now that we're managing and investing on behalf of our clients. And what this has really changed from a focus for us is the focus is really on generating high quality assets that generate yield on an ongoing basis for these insurance company balance sheets. And that's really where we spend the majority of our time on our financial services team here, is really on that large $400 billion bucket of what we call credit and yield, really high grade credit.
Well, thanks. And, you know, it's been fascinating watching Apollo kind of grow and change over the years that I've been doing business with the firm. So perhaps we'll kick off with just a little bit about what we're seeing from our data coming through the Demica platform. So just to recap, we've been tracking the daily sales of a fixed group of around 1,200 corporates since the beginning of 2020. The geographical split of those corporates is across, I'd say around 50–60% the US, Europe, and the balance US and Asia, and you've got this kind of sector split there, so reasonably well split. And you know, we started doing this at the beginning of the pandemic, but if we go to the next page, we've now got 3 years of data, and from that we try and kind of match up what we're hearing from customers with what we're seeing in the data and hearing from the market. So paper and packaging is an interesting one. You can see kind of every year has surpassed the prior, I think, driven by a couple of things, e-commerce growth being the first, but then a sustainability shift. And we've seen our clients in this space invest an awful lot in capacity to enable the transfer you know, kind of packaging materials from plastic to paper. We see that continuing. So whilst there'll clearly be, you know, an impact from economic headwinds, that's a sector that we're kind of optimistic about based on what we hear. You know, transportation and logistics is a big sector for us across land logistics mainly, and here you've got, I think, a surge post COVID or through COVID and post COVID on e-commerce leveling off a little bit, and you've got real exposure to the economy and cost pressures coming through. So we saw in the second quarter a significant increase in revenues driven by the pass through of fuel costs, and not yet seeing how that hits, but that's one to watch carefully. Moving over to the next page, computer and electronics. This is one that, you know, we've seen quarter after quarter kind of exceed the year-on-year performance, obviously lifted by that initial surge through the pandemic. This is the first quarter where across a pretty broad range of corporates in the portfolio, we've actually seen a year-on-year decline. It's difficult to tell whether that's down to supply chain challenges or it's down to, you know, kind of demand-driven challenges, but it is marked in a difference in the trend, and so one will be watching carefully. You can't draw too much from a month, but nonetheless, it does change the trend. And then kind of automotive. This has been the sector that's just struggled to recover its volumes to pre-pandemic levels, and we don't see any signs of that changing. And again, it'll be interesting to see how the industry moves it, you know, deals with the short-term headwinds of the economic cycle and continued supply chain disruption in conjunction with kind of longer-term trends as the supply chain changes with a move to electrification. Now, we don't think any, you know, much of that is in today's data. I think this is just a continued throttle back on supply, but nonetheless, you know, you see those lines there. Not much of a trend that you can follow. So an interesting one. And then finally, we move on to some work that we've done on payment terms. You know, the platform tracks the DSO, DPO, where we have the data, and you can see over the past 18 months a quite significant reduction in terms, which implies stronger bargaining power from suppliers. Now we're speculating to somewhat, but it does look like, I mean, the dates do coincide with supply chain challenges coming in. So you can see an increase in the bargaining power of suppliers and some increase in late payments. So that's kind of payments over 30 days in a corresponding period. So perhaps a sign that you've got that kind of balance of power changing. It's not feeding into defaults. It's not feeding into portfolio pressure from the banks that we talk to, but of course everybody's focused on kind of what happens next. So that's kind of what we've seen. I guess, you know, I'm really interested, Chris, in seeing whether, and this is always the question that makes me nervous, right? We hope that we've got a representative set and we're seeing the market, but based on what you're seeing, does that resonate? You know, what kind of trends are you seeing across the portfolio when you think about some of these industry segments and others?
I think it all does resonate. It's very similar to how you're seeing it, and if we take a step back, it's the first time in a very long time that we've had significant increases in interest rates in the U.S. We have that at the same time when we also have very full employment in the U.S. Employment's about as full as it's been for a long time, and I think we've seen similar trends to you when you think about supply chains more broadly, and whether it's some of the areas in electronics and technology where there's been so much pressure on the supply chain, shortages, delays, things like that, where we've also seen that impact transportation and logistics, where a lot of transportation companies are experiencing some of their best times that they've ever had. with the cost to ship a container from China getting to 10 plus times what it was pre-pandemic levels for a period of time. Some of that's starting to come down and normalize, but a lot of that still is at elevated levels. And we're very closely watching, what's happening from an inflationary perspective. And there's certain areas that are more impacted than others around that. And where the supply chain is the tightest is typically where the largest impacts come in for that. And so whether that's, having staff at hospitals and nursing and different things like that, whether that's, sort of the broader labor force that has alternatives and being able to drive pressure there. So we are seeing labor inflation, and that's something that is starting to move through across the board. And even as we think about some of our individual businesses, we have a fleet leasing business that has about 7 billion or so of vehicles in the U.S. that it manages on behalf of mostly large corporate clients. And the backlog is sort of double or triple where it's been on a historical average basis. A lot of this has been driven by delays in the OEMs being able to produce vehicles and deliver vehicles. So there is huge demand and supply has been shorted. Some of this is driven by the interlay with the semiconductor industry and other industries that drive supply chain for the auto OEMs, and it has this knock-on effect as it goes through, from a shortage of chips creates a shortage of vehicles, creates incremental demand. Used car prices in a lot of circumstances are above where new car prices are, and some of that has continued to sustain. So the value of vehicles that are being sold is incredibly high, right now. And then there's this sort of looming impact of what could happen from electric vehicles and sort of autonomous and all these other things. So from a micro and a macro perspective across the portfolio, there's a lot of things that we're watching very closely.
I think it was fascinating to hear you say that, because I remember after the financial crisis, I was looking after a fleet business, and there we were really hurting from all these vehicles coming back and the secondhand market collapsing and just taking loss after loss after loss, as we tried to kind of come to terms with what the outlook looks like. This is the opposite, right? You're staring into a downturn and you've got the opposite dynamic taking place. So it just shows how, I think, we're all in somewhat unfamiliar territory as we move forward. It's very interesting to hear your US perspective, because just by chance in the past couple of days, I've spent time with CEO of one of the large receivables discounting businesses in Europe and also in Asia. And similar themes from Europe and the US, which is, yeah, we get it. It should get worse, but it isn't, right? And employment is full and demand is robust. Did get a different kind of picture from Asia, whose point was, we're the canary in the coal mine, right? All the orders coming out of US retail, European retail, they're being placed into apparel, electronics. We're starting to see not stress, but volumes reducing. So I guess, we can all take out our crystal ball and pretend to understand what's coming next. But that was kind of an interesting perspective. I guess, though, as you think about the environment that we're in, and Apollo is a global business, how do you think about the US versus other international markets? Does this make you kind of more, I'd say, you're a global firm, but more domestically US focused, or do you think it creates opportunity everywhere?
We think there's opportunity everywhere. We're bigger in the US as a percentage of our business by a factor of history, not by a reason of preference. We've recently moved one of our most senior partners over to run our Asia business, Matt Michelini, and we're really focused on continuing to scale that business up. And we've brought in a really strong credit team in Australia that is continuing to focus on growth there. We have offices in Hong Kong, Japan, and India and Singapore. We're really focused on the India market. We're focused on a lot of different areas where we think there is an opportunity to bring a new form of financing, and one of the best approaches we think to doing that is actually through trade finance products. And these tend to be products that often are cross-border. They tend to be products that that often can be somewhat standardized. There's obviously jurisdictional issues and lots of other things to consider, but it's a really interesting way for us to think about our expansion and our growth. And this is an area in particular that is really that makes a lot of sense from a global basis. We have a very large presence in London. You know, it's our second largest office. And there's hundreds of people that work in our London office, and we're focused all around the European region. You know, and then we have a team that focuses on emerging markets, and historically we were, you know, less involved from a concentration perspective in emerging markets, but we've really bolstered that team and built it out, and we've done things. You know, there's some emerging markets are even misnomers, like the UAE is considered an emerging market, if, you know, by a lot of the ways that things get characterized, and we're probably one of the largest, if not the largest, investors in the UAE. So we've sourced a lot of our capital from the Middle East over time, and now we're actually focused on significant amounts of deployment in that broader region, with companies like Abu Dhabi's National Oil Company and Aldar and others like that. So we've made a lot of very large investments in those regions as well. So as we think about the future of our business, it's much more global than it is domestically. So you know, so we happen to source the majority of our insurance liabilities from the U.S., but we now have a very large business in Europe, and we have other exposures around the globe that we continue to scale and enhance. You know, the other thing that we're seeing that's really interesting, you know, as a global opportunity, and sometimes it makes more sense for some of the more developed countries, but there's been a time where interest rates have continued to decline really globally for a long period of time. And what that's done is it's increased the value of financial assets, but it's also increased the cost of financial liabilities. And what we're seeing now that interest rates have started to revert in certain areas is, while the financial assets are coming under pressure in certain areas, the financial liabilities are actually coming down significantly in value. So we have one of the largest pension risk transfer businesses, and that is one of the busiest times for that team as a result of what's going on, because there were, you know, these underfunded pensions, or they had fixed liabilities or things like that. And as interest rates went down, the value of that liability significantly increased. Now there's pockets where a lot of those have been able to be cleansed, and so it's just another interesting product that comes out of changes in the economics environment.
That's fascinating, and you know, change always breeds opportunity, and it always flushes out kind of issues. So we'll no doubt see kind of more of both emerge over the coming months. I'm sure the audience will be interested to hear about the platform business that you've been building, and I think you personally, you know, certainly it appeals to my you know, kind of GE Capital memory, such that it is seeing you go into some of these other asset classes and building kind of platforms through partnerships to kind of originate assets. It'd be great if you could share some insight into the strategy, and then notably on Eliant, as that's been launched in the past kind of 12 months, starting to gain traction, I understand.
Absolutely. So we've built this, what we call the yield platform strategy, and where this really came from is, as we've continued to grow our AUM, really around this insurance retirement services strategy here, we've been looking to continue to grow origination, because we don't want to just be in the liquid CUSIP market. We think that is a huge part of our business, and it is important, but we want to also have a very large amount of direct origination. And we had an investor day about 12 months ago where we said we want to grow our direct origination to $100 to $150 billion over the next couple of years. We've made very significant progress on that across the board, and we're really focused on generating these assets directly, because by going direct, we're able to provide more flexibility to borrowers. We're able to have a better sense of the credit risk that we're taking, as opposed to just in buying a QSIP, and we can really structure customized solutions for all of our clients and create a win-win for ourselves and being able to have interesting yield assets, and for our clients and being able to provide interesting solutions. One of the stats I think that tends to be most surprising to people when we talk about our business is 90% of our yield business is investment grade, which is so much different than how people have thought about just the opportunistic side of the business in the past. So we primarily are focused on really high grade or investment grade like products across our platform. And so we've done this we've been out buying and building origination businesses. So we talked about Fleet, that's a $7 billion business. We have a large direct lending business in the US called Midcap Financial. That business is about $45 billion in managed commitments across it. We have a large structuring business called Redding Ridge, which does CLOs and larger scale lending. We have a bunch of consumer finance businesses. We have mortgage finance businesses. We have equipment finance business. We have a lot of different businesses across the board. And where we've really been focused is also on trade finance. Trade finance is one of the largest sectors in the world, and it's a global business, and it's something that we've spent a lot of time talking to Maurice and his team about over the years, and a place where we think it continues to be ripe for innovation and expansion, and where there are products that make sense for investment grade companies, there may be products that also make sense for non-investment grade companies. Where there are products that that make sense for large suppliers, expanding that down to the long tail of suppliers in certain ways may be interesting. And there's been a lot of investment and focus on trade finance over the years from technology companies, and obviously Demica has been incredible in sort of the shift of awareness for the industry, efficiency for the industry, and what we're trying to think about is how can we bring flexible capital, incremental capital, not to disrupt the industry, but to be additive to the industry, to provide incremental solutions, to partner with the banking institutions that have built very large businesses in this space, to enhance the products. And if it makes sense for a client to have a longer duration solution, maybe we can pitch together with a banking institution and provide a joint product that provides multiple different types of things that we can solve from two different capital sources, an insurance source and a bank source. And you asked about Alliant in particular. Alliant is today is an inventory finance business. And what Alliant does is it actually acquires inventory on our client's behalf, and we own that inventory on our balance sheet. And so it's almost like a next generation of a just-in-time. It's not just-in-time, where it is not necessarily in stock. It's really more of almost a just-in-case. And when we've seen pressure on certain parts of, whether it's the technology industries or otherwise, being able to hold excess inventory without having to put pressure on corporate balance sheets is a really interesting solution. And so we have a number of very, very large clients that have come into this program really for this just-in-case model. And we have been, we announced our partnership with BNP on this inventory product earlier this year, which is something that's been going incredibly well for us and for them.
And a couple of questions come in from the audience related to it. I think the first, do you think that inventory monetization grows as an alternative to payable financing? And the second is on pricing, right? Do you think corporates will pay the premium to kind of fund their just in case inventory. How how close is the need from a kind of an Apollo kind of cost capital to where market demand is?
Yeah, we definitely don't think this is a substitute product. We think this is an incremental product. And as large as this industry is, we think the increased penetration for incremental products and for incremental clients, because this has really been focused a lot. There obviously are lots of products and many billions of dollars in non-investment grade trade finance, but it's been more focused on the investment grade side. So being able to provide products that work for non-investment grade companies and really expand the penetration of trade finance into those companies is additive. And we think having incremental products is also additive. None of the clients that we've been talking about inventory solutions with have been looking to turn off other funding and replace it with this. They've been thinking about this really as an additive product. And as the supply chain world shifts and as there continues to be volatility in the market, I think people are really trying to figure out how to use this as an additive tool to what they do when they think about their suite. And it's really how finance has really developed across the system. The larger, more sophisticated investment grade companies always expand into these products first, and then those products start to move down, and then they're continuing to evolve and innovate on the really large and IG company side into new and additive products, and then they continue to fall and flow down through the system. And that's really what we're seeing here. So we're seeing the innovation start with the larger companies. The innovation from a couple of years ago has started to move down the system already, and we think this will be how it plays out. But the days of an LBO being done by a private equity fund where it only has a bank loan and maybe a bond, we just don't view that as the future anymore. We view this as, there's lots of ways to optimize these capital structures, and by taking that sophisticated approach, that's really what's additive. And so even though I spend very little of my time ever doing LBOs anymore, we spend a lot of our time as a team partnering with our private equity team to think about new structures and alternatives and financing, and it's really all additive to what they're doing.
Because that resonates with me, because I don't think it's a pure financial calculation when corporates look at these products, right? They provide certain structural differences, right? The off-balance sheet nature of the product has its attraction, but it's also the operational efficiencies and sometimes the sales efficiencies that you get by being able to vary terms, and that has a premium that you can capture. So if you're looking at it from a pure cost of capital calculation, you might say, well, why would you ever, and especially in times past, why would you ever kind of buy at price A when you can fund yourself at rate B? But it's not quite as it's not quite as straightforward as that. One thing just to pick up on, and then we'll move on to some of the market data that we've got. But one of the things that to pick up from what you said is that I guess post the Athene Apollo merger, 90% of your liabilities are investment grade. Do investment grade companies, when you turn up as an investment grade counterparty, see you that way, or is there still a lag from the origins of Apollo and the fact that most of that origination is indirect, I suppose, still from the insurance side?
Yeah, look, it's a great question. I think what we have found is there is continued surprise in how low the cost of capital is that we're able to bring to bear, and how flexible the cost of capital is that we're able to bring to bear. And we're starting to see a shift. And so when we are out meeting with some of the largest companies in the world and talking about the products that we have, no longer do they think about us in that opportunistic bucket. But when we first reach out, if they don't know us, and they're like, oh, Apollo, that's just a private equity fund, or maybe they have a hedge fund or something like that. And we're really spending a lot of time telling our story to really to a lot of people that are members of the audience right now. We're telling our story to a lot of the largest banking institutions in the world, where we're really coming in with open arms and want to be a friend and additive to the industry. And we're doing that with very large corporations. And what they're starting to see is, oh wow, like if I need 5, 10, 15, or $20 billion of capital that's a little bit more flexible, this is a call I can actually make and get huge solutions of scale. We provided Hertz Rent-A-Car. They went through some trouble at the very beginning of the pandemic, and they've actually come out many times stronger on the other side of the pandemic. But there was a point in time where they needed to be able to buy vehicles, and there was a long lead time in buying them. So they asked us for $4 billion of financing to buy vehicles, and we gave it to them in 7 days. 7 days start to finish, that entire process. We did something similar, with 2 other very large investment grade companies in very short time frames. And these other 2 weren't liquidity needs, but they were just focused on how many things they have going on and trying to do these things quickly. But we provided in a couple of weeks $3 billion to Abu Dhabi's national oil company, and we've provided many billions of dollars to Anheuser-Busch in very short periods of time, as well, as they're thinking about growth and expansion and other things like that. So there's a lot of interesting solutions like this that we've been able to start providing. And you're right, Maurice, the firm has been around for 30 plus years, so there is a lot of historical legacy views of what we do as a firm. And even when we're meeting with CEOs of the largest U.S. banks or international banks that know us incredibly well, and our CEOs are very close friends. We had a meeting with one of the largest banks in the world last week, and they were shocked at how big our investment grade direct origination is. And you're right, there still is some of it in the secondary market. We do buy a lot of large investment grade corporate bonds, but we're shifting. We're about mixed right now, and we're shifting to be much more on the direct origination side than on the secondary side. And it really is a different strategy than most others have taken in the insurance retirement services industry. And it's at a scale where it can be relevant, because even if a $50 billion insurance company sounds like a large company, it's actually not. A $50 billion insurance company can't go provide $1 billion solution or a multi-billion-dollar solution. They can provide a couple $100 million solution, maybe. And by being a $400 billion insurance company with shadow clients that really make us feel like we're well north of 500 billion, that allows us to provide solutions of scale that are flexible, that are really attractive from a cost of funding perspective. This isn't about paying, very, very large premiums for flexibility. This is about creating incremental flexibility at very reasonable cost of capital.
No, fascinating. So I guess we'll spend a little time, Dan, if we can just flip the pages back up to get our perspectives on, share perspectives on, what's going on in the market. I think it's page 4 like that. So this shouldn't be a surprise, right? Increased inflation means higher, higher sales volumes, which means high volumes, right? For receivables finance. Increasing interest rates makes the relevance of lower cost asset-backed or asset-based financing higher up on the radar of the corporate treasurer. And as we enter into a recessionary environment where potentially supply of credit, I'm not sure that we've seen that in some of the sub-investment grade markets, but not necessarily across the board. That tends to coincide with a positive outlook and trading for the supply chain finance business more broadly. So we've got a statistic there that comes from S&P, which references 26% year-on-year growth from talking to probably, I'd say 6 or 7 banks between Matt and myself over the course of the past kind of month or so, that's a conservative number. So it's market volumes are increasing based on what typically happens at this point in the cycle and what we're hearing from customers. And then when we've looked at some of the historical data, if we go to the next page, you can see it play out in the numbers. So kind of a couple of interesting things. Again, we're speculating a little bit, but we've plotted here the FCI data that is probably the most reliable industry data on kind of receivables finance. And the kind of purple line is the FCI numbers, and the red line is the FCI estimates of world total in receivables finance, which is just increasing at a much faster rate. And that resonates with us as we see adoption of the product kind of grow geographically and also across different customer types and in regions that may historically have thought differently about the product. There's still some remnants of the product as a kind of an opportunity of last resort, and that's changed. It's changed, I think, but it's still changing, if that makes sense. And then on payables, just incredible growth, right? And again, it makes sense, right? You've got a lot of capacity that's been put in place by banks, by platform providers like ourselves and others. And as as time has progressed, we've seen kind of those start to ramp as they onboard suppliers. So significant growth across the industry. And I guess the themes I'd like to dig into a little bit is that kind of, you mentioned it, right, which is you're not looking to necessarily compete with the banks, but to complement what they do, right? And banks, this is such a central product with banks because it's not just a financial product, it's part of the whole transaction banking ecosystem that the banks kind of leverage, and the intimacy to have with their customers and their funding rates mean that I don't see that changing anytime soon, but there's a lot of growth to be had. So I'm interested to explore a little bit on how you see that coexistence taking place between alternative kind of private credit funders such as yourselves and the mainstream traditional providers of the product.
Yeah, look, I really think it's 1 + 1 = 3, and it's really what we're seeing across the board, and it's because look, what we always want is we want the asset yield, and the traditional providers to the space in the banking space want the client. So we're not looking for the client. We don't have, we can't provide treasury services. We don't take deposits. We can't, do all of the different things that are part of a broad corporate treasury relationship. But we have a real desire to be part of the yield and part of the asset. And we're increasingly finding that there is value to partnerships in the space, and having it be that the clients continue to be owned by the bank, which is the most relevant place for those relationships to be owned. And we don't come in and take all of it. We just come in for pieces of things, and sometimes there are pieces that are different, so that we can collectively provide a better package solution to clients. Sometimes there are things that are just additive in scale, where a financial institution wants to provide X billion dollars, and there's a hole, and we can fill that extra hole and get to a much larger scale product. And both of those are really additive because there's incremental flexibility and there's incremental capacity. And those are the things that are really most important from how we're thinking about this. But we don't have the capacity or the capabilities to become a full service trade finance provider of all the end-to-end solutions that the banking institutions have been doing for decades. We really are coming in to provide incremental additive capacity, flexibility, and to enhance the package offering that's available out there. And we see a lot of demand for this from large corporates, and we're having a lot of these, like a lot of inbounds directly from very large corporates, especially on the Align product. And we think that this is going to continue to progress, really, because these corporates are always thinking about how do they be more innovative in their capital structure. And the more that, yeah.
So I'm interested in digging into something with you, because we've got a lot of the attendees on the call are product managers in banks, right?
Yep.
So they're thinking about product, and in some ways, what I think I'm hearing you say is that, well, we've got certain attributes, right? We can be quick, we can be, we can combine different parts of the capital structure to bring them together, and we can react to customer needs. Does that start to take you down the road of thinking about product differently, right? I mean, Apollo, I'd imagine, even with its transition, it must still be a highly transactional environment, right? Does that start, kind of getting you to think about product development and how you collaborate, or is it still very much on the deal?
It's very much strategic, and our CEO Mark Rowan is incredibly focused on strategy and long-term strategy, and how do we develop a strategy around all of this. And so it's all about product development that is scalable, and that is additive. And so so for us, as we think about product development, product innovation, it's really about enhancing what exists. It's not about replacing. And we don't have the ability to replace it or the desire to replace what exists. We're trying to find things that are additive. So some examples of that are duration. Most borrowers and lenders think about trade finance as short duration.
Yeah.
We look at trade finance and we say it is perpetual, it is constantly renewing, it is predictable. And there may be desires, especially when there's liquidity crunches, which we'll see what happens in sort of the looming potential risks. When there's liquidity shocks to the system, borrowers focus on committed duration, and there may be ways for us to continue to evolve certain products in this space. And we see it from both sides, because we have a massive portfolio. We own, probably 80 plus companies across our portfolio. And when we are talking to all of our companies about how to think about borrowing and how to think about structuring duration and capacity of liquidity, but also to provide innovation and new product types away from just a traditional, leverage finance capital structure. This is constantly what comes up, is how do I protect against that duration and how do I innovate? So we're thinking about it as a borrower and as a lender, and as we're solving problems or finding solutions for our existing portfolio, we're also able to find solutions that are scalable and that we can provide externally as well. And again, we want to do this in partnership with the product development teams that are on this call, because we think there's an incredible opportunity to really add incremental flexibility and incremental capacity to underlying borrowers to make everything more relevant.
It's interesting because the way we look at product is very much tech driven. So we as well are not looking to revolutionize the way products are delivered today, because banks are slow to change the way that they underwrite risk and that they hold risk and monitor it. What we're trying to do is to engage with product teams to understand what's the next level, how does it iterate to become more efficient, more client friendly, and better. And I think coming at it from both sides, from the perspective of product as a financial product rather than as a technology product, a lot of that resonates.
And I think, Maurice, to your point, I mean, I've talked a lot about sort of the lending and the balance sheet side of things. We also don't have the technological capabilities, and so and what you guys have built is incredible, and just it really is. It's like 1 + 1 + 1, because technology is incredibly important to this as well. Equals significantly more than 3 across the board. So I think that's just it's a really important point to make.
Yeah, thanks for that, Chris. One final thing from me, and then please do post on the chat if you'd like to ask a question. But one final thing from me, I've been covering private equity in different guises and shapes for a long time, and it's interesting, kind of going to see private equity practitioners today with the product set that I'm offering. Is you kind of get two reactions, right? You get one that I think is the enlightened minority, and then the rest. The enlightened minority will say, you know what, if we have accounts receivables or working capital finance opportunities in our portfolio, we need to action that, and we need to make not at any cost, right? There has to be a prioritization, there has to stack up, has to be big enough. But for maybe, kind of 10, 15% of our portfolio companies, there's something that we should do, and we should do it methodically, right? And therefore it's part of the playbook. What you and that leads to repeatable business, and it leads to flow, and that's the kind of things that we look for. But then you have others who are like, yeah, we get it, we'll call you if we need you, and it will probably be when there's a problem, right? There isn't because there are too many other things to do in that critical 18-month period when you get control of a company and you've got to do what you need to do to kind of drive the value. I'm just interested in your perspective. I guess you must have seen it from both sides of the fence. I don't think one or the other is necessarily 100% right or wrong, but I'm just interested in your advice, perhaps to us, as to how we move that. Should we move the dial? How do we move the dial?
Yeah, look, it's a great, and I think it really comes back to what you asked about earlier, which is this planned and strategic for how these products are thought about, both as a borrower and as a lender, or are these products things that you just need when you're in a liquidity crunch, or are these products things that maybe if you found the other low-hanging fruit, you can go try to find this. And we think it's like this should be part of the planning for corporations, and the large investment grade treasury teams are incredibly sophisticated around how they think about liquidity and structuring all this stuff. And what we're seeing is that that's starting to just move down the system, but it has to be planned, because if you wait until you need the money, it's too late. And so what we've encouraged our portfolio to do and to think about is to build all these products in, and even if you don't need it, and even if it's not fully optimizing every basis point, what's important is to have flexibility of capital structure, is to have diversification of capital structure, and that's what's most critical. And look, we'll see how this how some of the pressures continue to develop around the world right now, and we hope that the pressures abate. But if they don't abate, there'll be a lot of focus around what are the companies that have thought most about having breadth of liquidity, breadth of funding, breadth of products. And the more monolithic they are, the less they'll be able to survive and go on offense potentially during these times.
And we're seeing, I'd love to tell you that the upsurge in demand that we're seeing is due to our superior origination skills. Of course, that is true, but we are seeing a significant uptick because of what's happening. People are asking themselves those questions. We've had a really good question come in from the audience, which is, as Apollo isn't primarily focused on client relationships, but focuses on yield, how do corporates get comfortable and rely on that continued liquidity even in difficult times? It's easy for Apollo to pull the plug.
I think it's a great question. And what I said earlier is not that we're not focused on client relationships. It's that we cannot provide clients the full suite of products. And we do not have full treasury management capabilities here. And we're not trying to pretend like we do. But we view ourselves as a relationship financing provider. And everything that we focus on doing is on being a relationship financing provider. We also go beyond that, and we provide committed duration capital in addition to being that provider. We don't want to come in and just be like a lender for a short period of time. The cost of our team and our resources is too high for the one-off. We get calls a lot on like, hey, can you buy this $1 billion for the next 30 days? Like, that's all I need. And no, we can't, because we want a relationship too, and this needs to be a two-way relationship. And so to the extent that a client is willing to invest in our relationship the same way we're willing to invest in theirs, we're going to be there for them through the whole cycle, and we want them to be there with us through the whole cycle. We don't want to be, the call in the liquidity crunch where, that's the only time that we're relevant. We want to be relevant, through that entire cycle, and we have to earn that business, from these clients and from partners that want to bring us in with their clients every single day. But with 90% of our business being investment grade, and now a significant portion of that, the majority being directly originated from investment grade corporates, relationships are everything. And any stumbling block we have on that, we've been told by our CEO, is gonna have a massive negative impact on everything we're trying to build. And we're not going to be able to get to 150+ billion a year of direct originations, primarily from high grade companies, unless we can prove to the world and that we are this relationship provider that will be there and be stable through all forms of volatility. And I think what we do have as a history is we are probably the largest lender during times of volatility. And that's always been part of our history. We just want to make sure that that's stable. We're not looking for, the volatility anymore. We're looking for the stable relationship, with clients and through partnerships. That's really how we're focused on it.
And I think, maybe one thing to close on when we were talking about it, because you've got the opportunity that presents in an illiquid market on liquid assets, right? Prices go up, it must be tempting, right? But I guess for that volume of origination, you kind of got to take a different time horizon to the average yields that you can achieve on liquids versus illiquids, and at that level of scale, you can see that start to come through. Well, look, I mean, it's been a great conversation. I've really enjoyed it, and it's great to see how the firm has kind of transformed and changed. Certainly from the the first time I started dealing with Apollo, showed my age, was probably about kind of 15, 20 years ago. Very different firm, but very, very, very pleased that and appreciative that you spent time with us and our audience, and good luck, and I'm sure we'll find lots of clever product ideas to kind of jointly exploit over kind of coming months. So thanks very much, Chris.
Thank you so much for having me. It's a pleasure. You guys have been great to work with as we've been spending time in this space, and to the whole audience, thanks for the focus and the attention today. We hope to see you all soon.
Great. Thanks. Dan, I think we can close it.